Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon. We're both planners and partners at Brayshaw Financial, and you can reach us at 855-226-8551. And this is we got a show for you today that I'm actually really interested in. I love statistics. I love numbers. We're talking market myths that cost you money. And, there's a lot of information out there that people, run with, go away in May, come back some other day kind of thing. And there's a lot of that's looming in the world. But I think, from a standpoint of real numbers, just over the last 25 years, if you missed the 10 best days in the market, you would cut your return nearly in half. And I think there's a lot to be said about that and a lot of questions. And before we get into that, you can find us at info@yourmoneyontap. You can email us. You can go to the website. We have lots of videos and information. Love for you to connect with us on Instagram, Facebook, YouTube, and this podcast, Money on Tap, has been around for 8 or 9 years. So if you're just joining us for the first time, we have a massive library out there of information that you can garner. We want you to be successful in your investing. We've done some stuff on myths before, Dan. You have thoughts on this?
Yeah, I think it's interesting, particularly here with our kind of core audience being in New England. All the colloquialisms and these old sayings, I feel like I know they exist everywhere, but I think we hold on to them a little tighter in New England.
Oh, I think so too.
Yeah, basically chiseled in stone, and you carry them around with you your whole life.
I think they chiseled them over the 10 Commandments.
That's right. But fact of the matter is a lot of this stuff, even if it was true at some point in time, and I call that into question, certainly the trading dynamics and the way the market moves and the way news travels is so much quicker today. These old adages are clearly antiquated. I mean, you are missing out if you're really living by some of these things. Not to say it's not a good idea to be disciplined and have some deeply instilled approaches to managing your money. We're advocates for that. We tell people to study up, do your due diligence, and come up with things that you believe in. But, part of that real discipline is recognizing the fact that, hey, when times change, you need to change too. Not everything is meant to last as a guideline for the next 200 years. And I think some of these things go back at least that far.
I mean, I got to be honest with you, though, on some level, when we do have that, summer doldrum drop in the market, I think about that. I think about that phrase, go away in May and come back some other day or something.
Yeah, you could sum that up with golf and surfing. I mean, that's because everyone's on, taking vacations, But yes, it rang true for at least a period of time for a reason. Conditions have changed and this stuff just got to go the way of the dinosaur.
Yeah, no, I agree. Market myths that cost you money, and there are a lot out there. We're going to go through some of that today. And really our goal for the show today is not just to, set some conversation around, what to do and what to listen to, but really, what is the statistical best methods? How should you be, focusing your portfolio, handling your investments? Because one of the biggest issues we have out there is that people are so emotional about their own money. They get very fearful, and it's significantly easier. I've mentioned this on the show before. Every once in a while I go to Dan and be like, hey, this is my portfolio. Tell me, give me the worst of it right now today. He laughs. He's like, you got to sell this. You definitely need to buy more of that, and it's easier for him to look at it because there's no value to him. He can just give an honest, unbiased opinion. And when you're working with a financial professional, they are that sounding board, and you need some level of expertise behind that because otherwise, you're shooting in the dark and you're working from fear, and ultimately you want your money to grow and be there for you in retirement. And now it's time for Money in the News.
Up first today from Reuters, U.S. home builder sentiment drops to 7-month low in April, NAHB survey says. And the NAHB is the National Association of Home Builders, and they're tracking this Wells Fargo Housing Market Index, which dropped 4 points this month, which is the lowest to the lowest level, since September 2025, and it keeps it hovering below this 50-point scale that they they hope to realize as a break-even point now for 24 straight months, and the score as it stands today is at 34. So a lot of this has been attributed to the rise in costs. 62% of builders reported suppliers had increased building material costs due to higher fuel prices, including gas and diesel, and global prices have increased, global oil prices, by more than 35% since the start of the conflict in Iran. So as everyone is well aware, this war that started up here in the Middle East is having a significant effect on the flow of oil around this globe, as well as other goods that are manufactured in the Middle East. And I was unaware of it, but plastics is apparently a very big deal there, and that's an issue for getting some of those materials which are used, in basically everything that we're building these days. So this, newfound war here that we have and Iran's ability to close off the strait, has contributed to this. Additionally, though, we're still feeling some of the kind of pipeline issues built up over the tariffs regime that, was struck down and to a large degree in terms of the percentages, yet a 15% global tariff remains in place on everything. So, some of these issues related to builders and housing costs and all that are, essentially self-inflicted, although the administration, it's not referenced here in the article, they've rolled out a couple different programs to try and, ease the pressure on home buyers, including, the executive order on the elimination of institutional buying of single-family homes, which is a pretty big deal. The idea of potentially going public with Freddie Mac and Freddie Mae, which they believe would also impact mortgage prices and rates. However, just the simple material costs is something that builders, have to deal with, and are left very little choice other than to pass it on to the consumer, which is, having a negative impact, of course, on the buyer's willingness to get invested in new homes these days.
Yeah, I mean, this is like 2 straight years of below this, numbers system they use for contraction. Normally, anything below 50 is not great, and going from 38 to 34 is a signal of a major contraction in the housing sentiment. Really, what people are just saying in this article is that you just can't afford to build them. Yeah. I mean, that's really kind of the downside of that space. And I know that, like, even whether you're just building a house or you're doing some sort of renovations to your home, it's becoming costly. And I think that's one of the reasons there's a lot of negative sentiment around, whether it's Home Depot or some of these Lowe's and various stocks. A lot of companies are concerned about what that means for them, because just pricing is just going so up. I mean, if you want to change an outlet, you're going to spend a lot of money.
Yeah. I mean, the do-it-yourselfers on the rebound here for sure. I mean, the cost of services, one thing mentioned in here I didn't include is the labor cost with the deportations we have going on. I mean, it was a reality that I think everyone understood, that a lot of the kind of labor level manpower that's been used not only in this industry but in many, was on kind of the fringes of the citizen spectrum here, So unfortunately, with those people being moved out of the country, the labor costs have skyrocketed as well. So builders are certainly feeling the pinch, and they have really no other thing to do other than to pass on those increased costs, which obviously cools off the buyer sentiment. And I read elsewhere as well something having to do with the bureaucracy built into the just the zoning issues and everything that a builder needs to go through just before they put a shovel in the ground. In some areas in this country, it's upwards of $100,000 of additional bureaucratic cost that these home builders are having to deal
low.
with. I mean, it's if that's something that we can eliminate, obviously there'd be a boon in the housing economy. But anyway, there's a lot of significant pressure in this space. People are concerned with kind of the running away of the American dream. The white picket fence and 2.5 kids and all that is becoming less and less realistic, unfortunately, for generations here. But hopefully, with easing of this conflict and some regulatory efforts from the administration, we can open this market back up.
Yeah, absolutely. Next up, Trump accounts sign up 5 million kids with 1.2 million eligible for the $1,000 seed money, Bissett says. This is a CNBC article. This is just general reporting staff. It was just an article that was out there. I think Kate Dorr and Jessica Dickler had written this or been part of it. It's really very interesting. I mean, anyone under 18 can get a Trump account, and 5 million people have signed up. 1.2 million people have actually been eligible for the $1,000 deposit. And, what's really interesting about this is that, we have talked about, getting people involved in whether it's Roth programs and so forth. Lots of self-employed business owners, will pay their kids some money and then put it in a Roth to try to do this, and they're just making it straight up legal. But if this is a Roth-style tax savings plan or a 529 plan, kind of similar scenario, and it also allows us to add money to it. And I really am actually very excited about this, Dan. And the article does talk a little bit about the educational piece of how this is going to work. The Bank of New York Mellon has partnered with Robinhood to actually work on creating an app around this and allowing people to learn investing. And I think this is really going to encourage a new generation of financial stewardship and awareness. That, you talk to kids today and they don't even know how to balance a checkbook. They, write a check. Those types of things. And until it's, hey, I don't have any money. So this is. I'm going to turn this over to you, Dan, but I just thought I'm just very excited about this. I'm actually going to become a grandfather. I'm going to become a grandfather this year. So I'm super excited about that. And, we're not going to put anything in that child's account, of course, but this is really nice. And the fact that you can, as a grandparent or somebody else, put money into this. A couple of companies are actually matching some of these programs as well for their employees, which is pretty neat.
Yeah, there's actually an increasing number of companies that have agreed to do that. I do think that's tremendous. And one of the big kind of sponsors of this was Michael Dell, the owner of Dell Computers, and he's pledged, I think, $6.25 billion to help fund these accounts, which is obviously a massive number. But what's interesting, he's quoted here in the article, and I really like this part, so I'm just going to read it. But some of the things that he's promoting, for others to use to get involved, even at the municipality level, is that he can sponsor, this is the quote here, you can sponsor a zip code, you can sponsor a school district, an individual school, 10 kids in your neighborhood. We even have a city talking about if you're involved in community service, they'll add to your account. If you get good grades, they'll add to your account.
I thought that was really cool, too. Yeah. I'm actually glad you read that.
So, end of the quote there. And so I never even thought, honestly, of these kinds of, kind of civic contributions and just a motivator to, get kids going, not only learning about investing in the market and a little bit of stewardship of money and a little bit of due diligence on how to invest. And the investment options here are limited index funds, so it's pretty straightforward stuff, which I think only makes sense. But, the idea that, school districts and cities and towns across America can incentivize good behavior or achievement or whatever they feel like, quite honestly.
Involvement.
Yeah, any involvement, exactly. Good word there. Because there's really no limits or stipulations on what would define a gift or what would allow anybody to contribute to somebody else's account. So, really, one of those few opportunities to, to see a publicly funded, publicly followed incentivizer to do good things. So I think that was a real win.
Yeah, no, I think it would be great when you start contributing to my grandchild's account.
Absolutely. There's no limits to my charity either then. So that's
I don't think there's any caps here.
Up next from Reuters as well, Lucia Mutikani. U.S. consumer inflation expected to have surged in March amid Iran war. And this ties into a little bit of the first article here, but is diving into core inflation as kind of the bigger topic as opposed to limiting itself to home buyers. But some statistics here: consumer price index forecast increasing 0.9% in March. The CPI is estimated to advance 3.3% year on year, and the food and energy likely gained 0.3%. Core CPI inflation estimated to have increased 2.7% year on year. And so that's a whole collection of statistics about the different ways that inflation gets measured. And that is the confusing part of that story, is that there are many different ways to gauge this. But the fact of the matter is whichever one you look at, they're going up, right?
Yeah, I think the article made a great point on pointing out that February had an increase of 0.3, but March had an increase of 0.9. So that's 3 times the increase. That's how remarkable it was. It's hard in these decimal point scenarios to have that conversation of like, this is a meaningful increase, but this is a large concern. And one of the reasons why they're talking about potentially raising rates, which is why mortgage rates have actually gone up in the last month, because of that fear and speculation, because a lot of that question mark drives into rate hikes.
Yeah, and this is one of the kind of contradictory things in the administration's workings. I mean, Trump got elected essentially on a number of issues for sure, but one of them was driving down inflation and getting Fed cut rates, worked into our economy to save on our bond costs, ease up lending, spurn the economy. All of those things make sense. I think we're all on board for a lot of that. But then he launched this war, which has the side effect of closing off 25% of global oil trade and many other things that come through that strait. So, I mean, it's like, a step forward, 2 steps back kind of a thing. And the fact of the matter is, all the pressure, Trump's put on Powell over the last number of years in office and out of office to get these rates down, threatened to fire him, has nominated his replacement. And then he takes these actions globally, which have national security implications, and you got to weigh that. I firmly understand those things. But now we're talking about Fed rate hikes, not cuts, hikes. And the idea or the notion of a cut for this year, most analysts are saying that is, essentially fallen off the board, for the remainder of 2026. So,
well, I think it's important about this article is that this is not a demand-driven inflationary hike. This is just a supply chain shock
problem.
Yeah, and so that's what the article does a really good job about explaining. And I think 20% of oil runs through the Strait of Hormuz, and we need oil to make plastics and all sorts of things. Like I think a lot of people think of oil and all these things. It's just about cars and transportation, and we all know it's involved in everything, but it is a massive piece to that, which has sent major industrial companies that thought they had a massive oversupply of things. I'm just thinking of like Dow Chemical, their stock has been down horrendously over the last few years because of this massive oversupply, and they're a big distributor to China. And you look at all these different pieces, but now everyone's questioning whether or not there's an oversupply. This could go on for a long time. And so now, you see that stock start rising over that speculation. So, and that's not an encouragement to buy. It's just really the thought process that goes through the purchasing of an investment. Do they have something we need and we're not going to have enough of?
Yeah, and you think about oil alone. I mean, I can't help but think about the move we made in Venezuela prior, right? So Venezuela's got all the oil in the world. I mean, they have a significant amount of reserves. Fundamentally, their oil industry just is so decrepit and just been dismantled through corruption. It's just not ready yet to supply what's been lost in this whole Iran issue. Some of these things just seem like, good ideas, some good potential for the United States of America, just not really thought out in detail, unfortunately. So I think we will live in this inflated oil price world for a little while here, regardless of what happens. But obviously, the sooner the better that we can come to an end of this conflict and opening up the strait.
Yeah, I think once that happens, we will be looking at inflation decline pretty quick, once things settle down.
Yeah.
So that's going to do it for Money in the News. We'll be right back with Money on Tap and our primary show, Market Myths That Cost You Money. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We'll be right back. Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today to start your journey toward financial independence. Brayshaw Financial Group, your partner in wealth creation.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon. You can reach us at 855-226-8551 or email us your questions at info@yourmoneyontap.com. And, we'd love for you to, if you're just joining us, connect with us on social media. We're out there, and we want you to be successful in your investing. It's important for you to be able to know what's going on and what's happening. For a lot of people who are interested, want to connect with us, send us an email. We'll put you on our newsletter list. We have some white papers and the blog that is based on the show and some of the key points to take away, so that for those who can't take notes, it's available for you. But we're talking about market myths that cost you money. And, there's a lot of them out there. I mean, and Dan, you were joking around about how that's a New England, they're engraved and etched in stone and so forth. And, one of them is, sell in May and go away, and, sell in May, come back some other day. I've heard a number of different ones. Market timing is the key to high returns. Now is the wrong time to invest. You don't want to invest now. I mean, it's the worst time, right? And holding cash is better than investing. Stocks are too risky. I mean, that's a big one. Investing is only for the rich. And one for our listeners, as we're on a Christian station, investing is like gambling. We'll talk a little bit about that because there are some people who have that and may believe that is a real hard-nosed fact, and I want to go through that. Fallen stocks will always bounce back. That's an interesting one. The more you own, the better diversified you are. That's a big one. Successful investors take big risks. Percentage gains and losses are equivalent. Gold is a safe haven. I got to own more gold, Dan. Can't tell you how many people. I mean, gold's done well. I can't.
Yeah, right now.
Right now. A high dividend yield means a safe investment. That's a big misnomer, but we're going to cover that too. And bonds are risk-free investments. So there's a lot of them out there. There's more. The list we have is long, and I think we're going to go through some of them. But you know. Lots of myths, they kind of persist, right? And why do they persist? It's really because, everything has kind of a small amount of truth or your memory really kind of rings true to some time when you experience something and someone experienced it once or twice. But, the idea that, go away in May, I think about that. But actually May on historical averages actually is a good month, and the following month is good traditionally. So, but why is that? Because, some of the big sharp declines happen in those months historically a couple times, and they were painful. So people rang true. But I had mentioned earlier in the show when we first opened, if you miss the 10 best days in the market over the last 25 years, your returns would be nearly half as much. Just 10 days. And I think that is really the point that, the market is an animal. It's something that's moving forward. It's positive 73% of the time. And, so the S&P is usually doing well. And so when you're out of it and you have these huge spikes in the market, I think that's really where people don't understand. That is your painful event. Like, I think it's interesting because people are like, well, I did really well here, and then I didn't do so well there, and then this, and they don't realize that they experienced one of those 10 days when they were somewhere, and it didn't matter what they were in, but they happened to have it. So that's kind of one of the biggest issues is that people try to time the market. They try to get out when things look bad, and then all of a sudden you have this huge spike. Like if you missed the recovery in 2008, forget it. 2008, 2009, people sitting on the sidelines, the market fully recovered, started growing. And then all of a sudden you're like, oh, I should get in. Now you've actually realized a loss when you sold at the bottom and never got back in because you were too fearful. And fear drives a lot of decisions, which, God says, fear is not for me. So there's a lot inside this that is just, are you an investor or are you a gambler?
Yeah, and I think part of, in the open we talked about how just market conditions and how people invest these days have made things that may have been either, I hate to even hesitate to say true, but maybe slightly truer in the past. They're just out the window today. And that is, the notion that we've experienced here going back to 2008 is that every time we've had any kind of a steep loss or drop in the market, it's been quickly followed up generally by one of these, quote, V-shaped recoveries that we've seen, right? So there's a precipitous fall driven by, the financial crisis, the, too big to fail idea, COVID, whatever it was. And, there's been these, short-term disruptions in the market that have caused significant and painful drops. However, it's only a drop if you sell, right? You only realize that if you get out of the market as it's tumbling down versus just kind of riding it out. And the problem is that I think, paints this picture truly, about missing those best days is often those better days are on the heels of a big loss. So people who run away from the market because of the experience that they're realizing in these drops in market value, they seldom are back in time to catch the best part of the recovery. So they're forever running at a deficit because those initial first recovery days that were steep inclines, they just weren't participating there.
Yeah, and I think, as people make decisions, people don't make decisions because of the lack of information. They make decisions on bad information, and they think the information's good, but it's just not actually accurate. And so when you start looking at these different pieces, you start saying to yourself, okay, well, when I start responding to information that I don't know is really true, or it's just, it's kind of like the racetrack theory. Somebody used to say to me, it's like the racetrack. It's like no one will tell you about the horse they bet on and lost, but they'll tell you about, or the 20 horses they bet on and lost, but they'll tell you about the one time that they won big, and they're still behind and they still have lost money overall. And so, understanding that, the second you decide you're getting out of something because you're speculative about some event, you're market timing. And at that point in time, you're potentially gambling. And so I think it's important that people understand that when you invest in a profitable company and you want to be an owner, if you own a business and you believe in yourself and you believe in what you're doing and how you're doing it, you don't look at it as gambling. You're an owner, and if someone says, "Hey, do you want to come into my company and buy a portion of the business and own it with me and run this thing with me," you wouldn't see that as gambling. When you buy stock, you're becoming an owner of a company. So I always encourage people that you should be looking at healthy, profitable companies that actually have an offering that people want. Right? You don't want to own a company that's closing stores and going out of business, and we don't need Nintendos and Game Boys anymore. We have cell phones,
right?
So at that point in time, you're like, well, this is an unhealthy business. I don't really want to buy into your company. Well, that's the way you should look at stocks. And once you do that, and you start saying, hey, listen, this business is no longer a business that has real opportunity. Well, then you're not gambling when you get out, and you're not market timing. You're just making a decision that you feel like this company has run the race that I believe in, and that's where you go. And so, the decision should be logical. And once you're putting logical business decisions in place, gambling's gone. Like, that's out the window.
Yeah, if you're doing any degree of due diligence, you're placing your investment, based upon some information you've gleaned that, shows you that there's potential for upside here. This isn't about luck and chance and, how the cards may fall. It's, if you're making investment decisions based like that, literally throwing the dart at the, list of tickers, well, that's gambling, because there's no intuition there. There's no thought behind it. That is chance.
Right.
Versus, to whatever degree, it could simply be reading an article or having a conversation with someone that seems in the know, all the way down to, ripping through balance sheets and understanding P&L statements from these public companies. So the wide range of acquisition of information that can help you determine, what you think is a good investment for you. But, as long as that effort exists, then you're no longer gambling.
Yeah, no, I think that's a valid point. And so let's talk about, market timing, because that, I just said that is a version of gambling. A lot of people look at market timing as like, hey, so you're going to put my money right in the market right away? Like, we're not going to wait for a good entry point and so forth? Well, what's interesting is that, you can look at dollar cost averaging. A lot of people are proponents of dollar cost averaging, and I don't really fight that much, but the statistics actually go against dollar cost averaging. And that's because of these missed days in the market where it's up. I'm just going to go through. So we talked about, if you missed the best 10 days. So the annualized returns over 25 years, fully invested, is 7.98%. Okay. If you miss the 10 best days, your average return goes to 4.54%. If you miss the best 30 days, Dan, you might as well have been in a money market. It's roughly about 0.47% or about 0.5% annualized. If you miss the best 50 days, you're now losing money. That's
incredible.
That's really incredible. You're negative 2.62%. And so that's really one of the things that I think people need to understand is that, every time you're out of the market, you don't know what's going to happen. The statistics on lump sum versus, buy it all now versus dollar cost averaging, a lump sum outperforms dollar cost averaging 67 to 75% of the time. And in U.S. markets specifically, 68% of the rolling 10-year periods. So if you look at all the different 10-year periods, 1 to 10, and then 2 to 11, and it's just really interesting. In shorter periods, 64%. So 6 months. They're basically. If dollar cost averaging really worked, and you did it over, 6 months, you think it would work, but actually 64% of the time it doesn't. 92% of the time, 36-month dollar cost averaging doesn't work. And so when people want to do dollar cost averaging, I really don't want to push against. I tell them the statistics, I tell them the facts. And, I'll say, listen, if you want to do dollar cost averaging, we can do it over 6 months, but, no more than that. Like, usually I'll do, 3 months or something like that, but not a lot.
Yeah, I mean, the market represents an unknown, and we would encourage people not necessarily to buy at the high, right? So if you come in with an asset, we might break it up and move some, in at a later date, simply on the fact that, the market is at a crest, it's at an all-time high. So you can get some kind of a short-term reprieve and a little bit of a drop and kind of capture those points. But, there's just no doubt about the fact that being in the market is your best move.
Well, and I think if we had an S&P 500 death cross,
yeah.
We probably wouldn't be like, let's throw your money in the market. I mean, there are indicators that are always sideline judgment calls that you want to have with your planner. But the actual return for people over 10 years, lump summing is on average 2 to 3% higher over a 10-year period, which isn't a whole heck of a lot right off the bat. But when you start looking at 20 and 30 years, it's a massive difference. And that's because of those 10 best days or those 20 best days that you're in for the market, because a lot of people move them. But that's an average. I thought that was interesting.
Yeah, it is interesting. But, the fact that those, the best and the worst days are so closely clustered very often, I really think that's the best argument to say, hey, listen, you're in the market or you're not, and if you're in, be all in and ride the tides. And if you're exiting from an emotional reason, you're just setting yourself up for permanent damage to your portfolio. If you really believe you're going to get out of the market, have that be driven by, your opinion that some condition that's negatively impacting the market is simply going to persist for a long time. If you don't see it that way, just stay in.
Yeah, and I think the reverse is true too. So if we had a golden cross and the market on the historical averages, it looks like it's positive, like we're going to get your money in right away. We're going to say, dollar cost averaging doesn't really make sense here. So those are important points. So we talked about the sell away and go in May, and I have some numbers here that are pretty interesting, Dan. So sell in May, go away. Average S&P 500 return since 1950 to June of 2025. In May, we're up about almost 0.5% on average. June, we're up almost 0.25%, and then July, 1.13% on average. I mean, that's pretty.
Yeah.
Matter of fact, August is up, but just a little bit. So it's kind of interesting. The actual average most negative month is September. I mean, February being the second one.
Yeah, that's when people are telling you to get back in, right? By the old adage, in just in time to take a 4% loss.
Yeah. That's really funny, actually. So, the sell in May and go away is just, it doesn't make any mathematical sense because historical averages say. And this speaks to the point of being available for those 10 best days because, yeah, maybe there was a few, June, Julys, wherever, where we had a market crash or this, that, and the other thing, and people were like, oh, I'm never going to be in the market during this month. But on average, it's had some great months.
Yeah, and if you look at the statistics of it, there is no real seasonal pattern that rings true on an annual basis. It just doesn't simply exist in that fashion. And wherever there are these, perceived or minimal downturns, just the cost of exiting and then re-entering, a portfolio and just the activity around that, it would probably wipe out any nominal savings you might have hoped to achieve. I mean, there's no doubt, just given the factor of the unknown, you're better off just being in and saving yourself the costs.
Yeah, absolutely. Hey, we're going to take a quick break. We're talking market myths that cost you money. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We're going to start getting into holding cash is safer and stocks are way too risky, Dan. Don't go anywhere. We'll be right back.
Hey, this is Seth Krussman with Brayshaw Financial Group. Are you looking for a hassle-free way to invest? Look no further than Brayshaw Financial Group. With Brayshaw Financial Group, you can start investing with as little as $100 and enjoy a user-friendly platform with diverse ranges of investment options. Visit Brayshaw Financial Group and start your investment journey today. Brayshaw Financial Group, investing made easy.
We appreciate you listening to Money on Tap with Ben and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon. We're talking about market myths that cost you money. If you missed any part of the show, you can find this radio show on any major podcast venue out there. Money on Tap has quite a history of information. We encourage people to get informed, learn as much as you can, because finances are one of the biggest things about stewardship that you can possibly do. If you have questions, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can get the blog, the white paper on the show, any of those things, and some of the statistical information that we have here, and some of the resources of where we got the information too. Not all of it's buried in our head, Dan. Believe it or not, I'm not an encyclopedia just yet. A lot of people think that holding cash is, one of the biggest, proponents. I hear that all the time. Like, well, CDs. I actually talked to a woman who was referred to me by a very good client. Long story, but his mother, and concerned about the financials and so forth, and they had not made a lot of money, and then they come to find out that the reason they hadn't was they were investing with the bank. For a very long time at very low rates. And rates are actually pretty good right now. I mean, they're 3.8% is the money market rate we have. And you're not necessarily horrible. It doesn't quite keep up with the inflationary concerns and the cost of living scenarios, but it's better than a sharp stick in the eye, as they say. They should chisel that somewhere, Dan.
Yeah, that's another one of those myths. Huh?
Yeah.
Well, actually, that one's probably true.
That probably. So that's, one of the pieces that I think is really probably one of the biggest misnomers. Holding cash, stocks outperform cash by 12 times. I mean, that's just straight up a number. And for people, they're just always wondering about, how do I time money? How do I do distributions properly? And a lot of that fear that has been created is because people don't understand distributions. We've done shows on how to keep more of your income, how to do that, how to do it properly. Because ultimately, you have this accumulation phase, and it's easier for people when they're in pre-retirement, accumulating assets. They're putting money in, it's growing a little bit, put more money in, it's growing a little bit, and the numbers just seem to keep rising, because ultimately you're adding money and it is growing, so, and maybe you're not invested very well, but it's still growing because you see the number go up, and it's might only gone up less than what you put in, but yeah. you see it getting bigger. But a healthy stock portfolio has traditionally performed over 12 times. Obviously, cash is lower volatility and lower risk and so forth, but inflation just continues to erode cash assets. And if you look at the historical time period of cash investments, especially in the recent last 10, 15 years, it's really been horrible. People getting less than 1% even in CDs, nothing on savings accounts. So lots of concerns there. It's not like the 70s, but even that was a problem because inflation was so high. So this is a constant onslaught of issues around cash. And I really encourage people that if you don't understand the difference between that accumulation phase, which seems pretty easy and pretty healthy and pretty normal, and the distribution phase, and why can I take out so much less and than what I realized I could do, it's usually because you either have a tax organizational problem, you have a distribution problem, someone's not understanding the difference between how much you should take out of this account versus that account, because distributions are not just handled as like, well, I have this account and I just pull the money out. You need to massage this money in a way that you actually get to keep more of it, because we have this tax code that's very complicated, and I see this very regularly. We've talked about this on other shows.
Yeah, I mean, there's a big difference between doing it and doing it well. I mean, for sure. And if you look at cash, by comparison, if you put money in the bank back in 92 and held it for the next 25 years, or through 2025 rather, 100,000 going in, and the S&P 500, you'd have over 2.8 million. In the Russell 2000, you'd have 1.73 million. Gold, you'd be just under a million at about 980,000. If you were invested in bonds, dependent upon muni versus corporate, you'd have anywhere between 313,000 and 559,000. Excuse me. But sticking with the bank and just being in cash at nominal savings rates, your 100,000 would have grown to 228,000. So that's that factor of 12 times that we're talking.
It's less than 10% of the return of the S&P.
Yeah, I mean it's just not even close. And While you didn't lose anything, you slept well, you didn't take any risk, but you've left yourself in a significantly worse off financial position.
And we're talking S&P 500, and the S&P 500, it's the 500 largest companies in the United States. I mean,
you can't call it no risk, and you can't necessarily even call it low risk, but it's a reasonable investment to make.
Yeah, this is not like, hey, this speculative tech company out in California just opened their doors and signed a lease, and I'm going to invest in them. These are the biggest companies in America.
Yeah, hundreds of years they've been around. Some of them.
So we're not talking, and I think a lot of people don't necessarily understand what the S&P is and how to invest in that and so forth in a way that's healthy. And then also there's ways of mitigating the volatility of the market as you're dealing with distributions and so forth. This other myth, stocks are too risky. It's something, Dan, that I hear. Stocks are dangerous. I prefer to own bonds. I mean, bonds are less risky, but all of them have risk. I mean, even banks have risk, right? I mean, like if you put more than $250,000 in your account and you're a single person, you have risk. Banks, hundreds, thousands of banks go out of business all the time. I mean, it happens fairly regularly, unfortunately. The key statistics here are the S&P 500 volatility is 50% higher than long-term bonds, but return nearly double, which it should. Like if you're going to take twice the risk of a bond, you should get twice the return.
It should be rewarded for the risk.
Yeah,
absolutely.
Exactly. So there's one of those things that have a lot of conversation, but obviously, stocks have short-term volatilities, and there's potential for long-term failure to grow. I just don't think that there's just no risk to this, but are they too risky for you? It really has to do with not how you feel, but what you're trying to accomplish, right? Can it fit a portion of your portfolio? It doesn't need to be all your money. It doesn't need to be everything. And it doesn't necessarily need to be in the conjunction of owning an individual stock. There's lots of ways to mitigate risk inside the investing world.
Yeah, I mean, just the title of it, just the simple fact, stocks are too risky. I mean, it's just such an oversimplification. Well, which stocks? Are some stocks too risky? Absolutely. There's thousands of stocks I wouldn't touch with a 10-foot pole, But at the same time, there are many stocks out there that have the track record and demonstrated history that suggests this is a reasonable risk to take if you have an eye towards returns.
Yeah, and I have a client that inherited a stock, and it's a ton of money in one stock, and the great-grandfather owned it forever, and it's just some sort of heirloom, basically, that's out there that pays dividends to him. And every once in a while they call me and say, oh, that stock is, we're not trading it. It's just that he told me we're not selling it, whatever. And then they call me all fearful about the stock, and I'm like, do you want to sell it? No, we're not going to sell it, because they own this individual stock. The fear of it just going away is, well, you don't have any diversification. They don't want to engage in that. We've talked about it. We've gone through it. It's just one of their assets, but it's something they inherited. It's like, if you got a Hummel, I got a Hummel from my grandmother, it's on a shelf somewhere. I can't even remember which shelf it's on, but, we're not selling it, It's just, but that's how they envision this stock. So lots of people inherit stocks, and they think it's something that is forever the right choice because grandpa owned it and he bought it and so forth. Well, at some point in time, if you know nothing about that company, you are gambling. Yeah. Right? And that's really the problem, because when people say investing is like gambling, but it's just a legalized system. Let's talk about statistics. I mean, the casino odds, Dan, blackjack 49%, roulette 47 to 49%. I mean, these are the odds of you winning. Like it's not great. But with stocks, it's gambling it's historically a negative loser, and stocks are historically a positive winner. I mean, there's people don't buy stocks because they think they're going to go down. They buy stocks because they think they're going to go up. And statistically, 73% of the time, you're going to be right if you buy the index. I mean, that's pretty incredible. Year over year over year, 73% of the time.
I mean, just think of the simple fact of it again, too. You can kind of cut through the myth. When you go to a casino to gamble and you're looking at all the opulence and the marble floors and everything, that's because they're taking your money. When you go into an investment advisor's office and it's got a beautiful office and, nice accompaniments, it's because they're growing your money. They're with you. They're on the same side of the table.
Yeah.
As opposed to trying to reach into your pocket and just take it all.
I think that is a big piece of this, right? Like you go to a nice office, person's obviously doing fairly well for the most part as your guest, because they participate in your gains. They get paid a fee, and they get paid a higher fee if it grows. And so those are the things that you really want to. If the person's working out of a shack, I'd probably be concerned. I do know people have invested with companies over us because they walked into some marble floors in Boston.
Yeah.
And they didn't do as well, and then they came back, so it's kind of interesting. It does exist. I mean, for me personally, many years ago, introduced to possibly go down to New York City for some job opportunities. 9/11 happened. I said, I'm not going down there, and decided I wanted my humble life in New Hampshire. I wanted to be where my roots are, and so that was a big decision for us. Yeah, can I go into the city? Absolutely, but yeah, you want to make sure you want to see that. And I also encourage people, ask for referrals. And I can't even tell you, even some people that don't ask them, I was like, hey, let me give you some referrals so you can talk to some people. I want people to build trust. I want them to experience things. I want them to know who we are. Most people are referred by somebody, but I would say that honestly, if you can't go into an advisor's office, and yeah, everyone's going to give you a good referral, but you can ask very intuitive questions like, when you call them, how quickly do they get back to you? How does that? We've done shows on this, but there's ways to get information out of people that's not like, do you like the guy? Like, hey, how have your returns been? How have you experienced that? Have they adjusted or dealt with an issue in a loss, or how have they worked with your taxes? Like, that's a big, big question. If you're not engaging in the tax conversation with a financial professional, you're really missing out on a lot of your money.
And another big myth is, investing is only for the rich. You don't need a lot to get started. Just a simple example here. If you're putting away $50 a month for 25 years, that's a total contribution on your end of $15,000 over 25 years. I think this $50 a month is an easily attainable number for most with any kind of an eye towards their future. But if that was in a 60-40 portfolio, very conservative, you'd be at $48,000. You would have more than tripled your money. And if you were in an equity-based portfolio, you'd stand at $76,000. That's 5 times your money. So the opportunity to profit from the market does not require a substantial day one contribution.
Yeah, I mean, Benjamin Franklin said that compounding is the most powerful force in the universe. And so, those are things to really think about, because compounding is really, really the importance. Obviously the $50 a month is dollar cost averaging, but, we spoke about that earlier, but this is just because this is affordability. Like, you're just getting.
That's what you can do.
Right. You don't put the $50 in and then dollar cost average that in over 6 or 12 months or 36 months, some crazy thing like that. So those are important things. Hey, we're going to take a quick break. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We're going to talk about diversification when we come back. Are more holdings better? Wait and see. We'll see you in a second.
Hello, everyone. This is Dan Michelon of Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
We appreciate you listening to Money on Tap with Ben and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. So we're jumping into all these myths of the market, market myths that cost you real money. And, one of the things is that a lot of people continue to diversify, or they over-diversify. More holdings equals, better diversification. More stocks you have, the safer the portfolio. Here's a key statistic, which is really interesting. It was an evaluation done on 531 holdings, and the return on those was 9.45%, but the drawdown was a maximum of negative 19.3%. Taking a diversification approach, mitigating, trying to stay within similar sectors, competitors, and so forth. If you owned 2,935 stocks, your returns actually dropped from basically 9.5% to 7.33%. And your drawdown, your loss went from a negative 19% to a negative 26%. So you had more volatility inside your portfolio. And I think this really is just kind of a broader scale conversation to the idea that just owning more companies is just a better way of mitigating some of that return. Well, if you're happy with a 7% return and a negative 26% loss, that's okay. But if you're just a stock investor and you're like, well, I want to buy more companies. No, when we talk about diversification, it's talking about getting into different industries and sectors and start looking at best of class and start looking at profitable companies who are healthy, have decent yields, get companies that pay you to own them. Dividends are highly important in my mind. And so that's one thing. So more holdings doesn't necessarily yield better outcome. It yields more overlap, honestly. And, some companies are not performing as well as others.
No, I mean, diversification isn't about owning everything. It's about owning the best in class of whatever either style you choose to invest with or sectors you want to be in. You still need to trim away the companies that you don't foresee having any kind of positive impact on your portfolio. So there is some discernment that needs to happen. Again, diversification doesn't mean owning everything.
Yeah, and the big dip thing, we're going to zip through a couple of these here because I want to talk about the big dip. By the loss, by the stocks that have been trampled or have a high dividend because the dividend yield goes up as the stock value price goes down, and so people buy that, and it's like, well, that's not necessarily the story for success, right? You don't want to necessarily buy a company that everyone hates and no one's buying anymore. I mean, just because it's down doesn't mean it's going to go up. Yeah,
some things go down and stay down for good reason, and others are negatively impacted by things that aren't necessarily their business. And those are the opportunities you're looking for. A company could be in an S&P 500 fund and see a lot of selling action because people are moving away from the index, not the company. And to be able to make that determination saying this is kind of a false drop because institutions are exiting, but this company is solid and the profits are going to be there. Yeah. Those are the buy the dip things you need to look for. A buy the dip statement is all over the media, but that doesn't mean you just buy everything that's tumbling downhill.
Yeah, no, absolutely. I think I want to talk about the gold myth, Dan. I know we don't have much time left, but a lot of people say just invest in gold. Don't worry about everything else. I mean, gold is just a rock. I mean, let's break it down. It's a rock, and it's not that I don't own gold. It's not that I don't think that gold is an investment, but having all your money in gold is it's silly. It's just not worth it. If someone wants to call me on that, you're welcome to. But we've had a recent increase in gold in the last 4 or 5 years, and actually, I made a gold investment 4 or 5 years ago. It's like, hey, did well on that. It wasn't a big amount of money, but it was just something. And, like I look back on it and say, oh, I really wish I put all my money in that then. Well, the truth is that over the last 15 years, gold's only averaged 6.3%. I mean,
gold itself is kind of a myth. I mean, people used to run to it because it was stable in times of poor market performance. But the fact of the matter is, gold is as volatile as anything else these days.
Yeah,
it's up and down. It's all over the place. So it behaves more like a stock than the safe haven it was intended to be.
Right. And I totally get the idea of having some position in gold or silver or any of the commodity spaces. Sure. Totally legitimate, but having all your money there is just not right. I mean, stocks have averaged over that same 15-year period 14.9%, more than double. And that's pretty horrific, honestly, difference with the amount of intensity that people have around gold, because I know people get passionate about it. And then the bond myth, as we close this out here, bonds, there's no risk to them is what people say, right? And that's just not true. I'm going to list 3 of them right now. There's interest rate risk, there's inflation risk, and duration risk. One of the other ones that comes to mind is, reinvestment risk. Like you get a good bond today, doesn't mean when that thing matures, that same rate or a reasonable rate is going to be available. That happened to a lot of people over the last 5 or 10 years where they were bond investors, and all of a sudden, hey, I can only get a bond at 1 or 2%.
Yep.
Now I can't create my same income. I got to start spending my principal. And so these are real issues inside this stuff.
Yeah, bonds trade. I mean, the prices go up and down. I mean, if you're just to buy and hold and collect your interest until maturity and get your principal back, that's all well and good. It's a predictable outcome. But to your point, Ben, that, well, what do you do next? Because you don't know what opportunities will exist at the end of that 10 years. You just don't know.
Right. And the market just moves. The regular market moves. And there's really ways to mitigate that risk and so forth. Hey, we've been talking about market myths that cost you money, and they do. They cost you a lot of money. And if you're living inside these market myths, we want to encourage you to speak with somebody and kind of really get your bearings in a way that you can be financially stable and in a good place, and get yourself to a place where you can, mitigate and manage risk and work through these spaces so you can actually have a successful retirement. That's the point of this show, is really to get people steered in a direction that's sound and secure, in a way that you can understand what makes sense for you on the investing. We want you to be successful. Thank you for joining us this week, and we'll see you next time. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We'll see you later.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of Osaic Wealth Incorporated. Osaic Wealth Incorporated and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire 03110, and can be reached at toll-free 855-226-8551.